Welcome back to Finanzergy, the channel where we help you achieve financial freedom. In today's video, we're diving into something that impacts almost every aspect of your financial life, your credit score. Whether you're looking to buy a home, get a car loan, or apply for a new credit card, your credit score plays a critical role in determining the interest rates and financial opportunities available to you. If you've ever been confused about what a credit score is or how to improve it, don't worry, you're not alone. In fact, building and maintaining a strong credit score is one of the most important things you can do to improve your financial health. In this video, we'll break down the factors that influence your credit score, practical tips to boost it, and the steps you need to take to ensure that your credit score is working in your favor. So, if you're looking to take your financial life to the next level, stay tuned. Before we get started, make sure to subscribe and hit the notification bell so you never miss out on essential finance tips and tricks. Let's dive right in. Want to understand what a credit score is? To begin, let's first define what a credit score is and why it's so important. Your credit score is a three-digit number that reflects how responsible you are with borrowed money. Lenders, including banks, credit card companies, and even landlords, use your credit score to assess how likely you are to repay your debts. Your score typically ranges from 300 to 850, and the higher your score, the better your financial health appears to lenders. A higher credit score means you're seen as a lower-risk borrower, which can help you secure better loan rates, credit card offers, and even a lower security deposit for rentals. The FICO score is the most widely used scoring model, and it's based on 5 key factors. Payment history, 35%. Your payment history is the most important factor. It includes on-time payments, missed payments, bankruptcies, and foreclosures. Credit utilization, 30%. This refers to how much of your available credit you're using. High credit utilization can hurt your score. Length of credit history, 15%. The longer your credit history, the more reliable you appear to lenders. Types of credit used, 10%. Having a mix of credit cards, loans, and mortgages can positively impact your score. New credit, 10%. Opening many new accounts in a short time can lower your score temporarily. 2. Check your credit report. Before you start taking action, it's important to check your credit report. You're entitled to a free copy of your credit report from each of the 3 major credit bureaus: Equifax, Experian, and TransUnion, once every 12 months through annualcreditreport.com. When you review your credit report, make sure the information is accurate. Look for any errors or discrepancies, such as incorrect late payments or accounts that don't belong to you. These mistakes can lower your credit score and hurt your financial health. If you find errors on your credit report, you can dispute them with the credit bureau and have them corrected. Correcting inaccuracies can have a significant positive impact on your score. 3. Pay your bills on time. One of the most important factors in building a strong credit score is your payment history. On-time payments make up 35% of your credit score, so making timely payments is crucial. Even one missed payment can hurt your score and stay on your credit report for up to 7 years. Here are a few tips to help you stay on top of your payments. Set up automatic payments. Automating your payments is a great way to ensure you never miss a due date. You can set up automatic payments for things like credit cards, loans, and even utility bills. Use reminders. If you don't want to automate your payments, set up reminders on your phone or calendar to ensure you pay on time. Prioritize bills. If you're struggling to make all your payments, prioritize the most important ones first, such as your mortgage, rent, or car loan. These are essential for maintaining your credit score. 4. Reduce your credit utilization. Another key factor in your credit score is credit utilization. This refers to the percentage of your available credit that you're currently using. Ideally, you want to keep your credit utilization ratio below 30%. If you're using more than 30% of your available credit, it can negatively impact your credit score. To improve your credit utilization, pay down your balances. The more you pay down your credit card balances, the lower your credit utilization will be. Increase your credit limit. If you have a good relationship with your credit card issuer, you may be able to request a credit limit increase. This can help lower your utilization ratio, but be sure not to increase your spending. Avoid opening new credit accounts. While opening new accounts may seem like a quick way to increase your available credit, it can also negatively impact your score in the short term. It's essential to manage your credit utilization effectively because high credit utilization can signal to lenders that you're over-relying on credit, which is a red flag. 5. Keep old accounts open. The length of your credit history makes up 15% of your credit score, so it's important to maintain old accounts. The longer your credit history, the better it is for your credit score. Closing old accounts can shorten your credit history and increase your credit utilization, which can hurt your score. If you have old accounts with no balance, it's often a good idea to keep them open, especially if they're in good standing. Even if you don't use them frequently, leaving them open can help lengthen your credit history and maintain a healthy credit utilization ratio. If you must close an account, try to close the newest one rather than the oldest. 6. Avoid opening too many new accounts. Opening too many new credit accounts in a short period can hurt your credit score because it can indicate that you're overextending yourself financially. New credit makes up 10% of your FICO score, and hard inquiries, when lenders check your credit report, can temporarily lower your score. Each time you apply for a new credit card or loan, the lender will perform a hard inquiry, which can reduce your score by a few points. While 1 or 2 inquiries might not make a huge difference, multiple inquiries within a short time can have a more significant impact. Instead of applying for new credit, focus on improving the credit you already have. By managing your current accounts responsibly, you'll gradually improve your score. 7. Consider a secured credit card. If you're just starting out or rebuilding your credit, consider applying for a secured credit card. A secured card requires a deposit that acts as your credit limit, making it a safer option for both you and the lender. By using a secured card responsibly, making on-time payments, and keeping your balance low, you can gradually build a positive credit history. Over time, you can qualify for an unsecured card with better terms. Secured cards are often a good option for people with no credit history or those looking to rebuild their credit score after a setback like bankruptcy. If you found this video helpful, be sure to hit the like button, subscribe, and share it with others who are looking to boost their credit scores. Feel free to ask any questions or share your personal tips in the comments below. Thanks for watching FinenserG, and I'll see you in the next video.